If you go and search for trading strategies online, you'll find thousands of them. Moving average strategies, indicator strategies, pattern strategies, scalping systems, day trading systems, and everyone seems to be selling a new method that promises to beat the market. And what that creates is a huge problem for beginners, because instead of learning how markets actually work, they end up jumping from strategy to strategy looking for the so-called Holy Grail. But after many years of trading, studying markets and teaching thousands of traders, I realized something very, very simple, and that is most profitable trading strategies are actually built on the same core idea. They're just different variations of the same basic concepts. And once you understand that concept, you don't need 20 different strategies. You only need one. So in this video, I'm going to show you the simplest professional trading framework that most traders will ever need. And before we get into it, this isn't going to be a guaranteed way to win every trade because no strategy can do that, but it is a structured way of approaching the market that professional traders have used for decades. And when you combine it with proper risk management, it can form the foundation of a very, very profitable trading process. Part 1. Understanding market structure. Before we talk about the strategy itself, we need to understand how markets move. Price doesn't move randomly. Markets tend to move in structures. They move in waves of buying and selling. So when buyers are stronger than sellers, price moves up. When sellers are dominant, then price moves down. And this creates something called trends. An uptrend is a series of higher highs and higher lows, and a downtrend is a series of lower highs and lower lows. And this simple idea forms the foundation of almost every professional trading strategy, because traders aren't guessing where price will go. They're observing the behavior of buyers and sellers, and they're trying to align themselves with the dominant side of the market. Part 2. The core idea, trend and pullback. Now here's the core concept that sits behind most successful trading strategies. Trade with the trend and enter during pullbacks. Let me explain how this works. When a market's trending upward, buyers are generally in control, but price doesn't move up in a straight line. It moves up and then it pulls back and then it continues higher. And those pullbacks represent temporary pauses in the trend. Professional traders often use these moments to enter the market. Instead of chasing price after it's already moved up, they wait for price to temporarily retrace, and this allows them to enter at a better price with lower risk. The same idea applies in a downtrend. When sellers dominate the market, price moves downwards, but occasionally pulls back upward. Those pullbacks can provide opportunity to enter short and sell the market. So the entire strategy can be summarized very simply. Find the trend, wait for the pullback, enter when momentum resumes. Part 3. Identifying the trend. So the first step is identifying the direction of the market, and there's many ways to do this, but beginners should focus on something very, very simple. Look at the sequence of highs and lows. If price is making higher highs and higher lows, the market is trending upwards. If price is making lower lows and lower highs, the market's trending downward. You can also use simple tools like moving averages to help visualize the trend, but we'll do more of that in another video. But the key idea is this. You want to align yourself with the overall direction of the market. Trading against strong trends is extremely difficult and extremely risky. Trading with the trend allows you to ride the momentum created by large market participants, banks and institutions. Part 4. Waiting for the pullback. So once the trend's identified, the next step is patience. This is where many beginner traders struggle. Instead of waiting for the pullbacks, they chase the market and they try and get in on these larger moves quickly. That often leads to entering trades at the worst possible moment. Professional traders do the opposite. They wait for price to retrace toward areas where buyers or sellers previously stepped in. These are often called support or resistance levels. In an uptrend, traders wait for pullbacks towards support, and in a downtrend, they wait for pullbacks towards resistance. And this is where risk can be controlled more effectively. Part 5. The entry trigger. After the pullback occurs, traders look for signs that momentum is returning, and this could be a strong bullish candle in an uptrend, or a strong bearish candle in a downtrend, or a small price pattern that indicates buyers or sellers are stepping back into the market. This is known as an entry trigger signal. The trigger is simply confirmation that the trend might be resuming, and once that confirmation appears, the trader can enter the trade. Part 6. Managing the trade. Every trade must have two key components, a stop loss and a profit target. Your stop loss protects your account if the trade fails, and the profit target defines the potential reward. Professional traders aim for trades where the potential reward is larger than the risk. For example, risking £100 to make £200. This creates a positive reward to risk ratio. Over many trades, this mathematical advantage can lead to profitability even when every trade doesn't win. Part 7. Why this strategy works. The reason this strategy works is because it aligns with natural market behavior. Markets trend because large institutions and banks, they move the capital in waves. Pullbacks occur because markets need pauses before continuing. By trading the pullbacks within trends, you're attempting to align yourself with the dominant market momentum. You're not trying to predict the future. You're reacting to what the market's already doing. Now, this is important. No trading strategy wins every time. There will always be losing trades. Even excellent strategies can lose many times in a row. What matters is the strategy has a statistical edge over time, and that edge only works if risk is managed properly. A strategy alone is never enough. Risk management is what turns strategies into profitable systems. So if you want to start practicing a strategy, the first step is to not trade real money. Open a demo account, study price charts, practice identifying trends and pullbacks, record your trades in a journal, and over time, you'll begin to see patterns and start to build experience. Trading skill is developed through repetition and observation, not through shortcuts. So there's thousands of trading strategies in the world, but most of them are built on the same core idea. Identify the trend, wait for the pullback, enter when momentum resumes, and that simple framework has been used by professional traders for decades. And when combined with discipline and risk management, it can form a foundation of robust professional trading approach. Trading success doesn't come from constantly searching new strategies. It comes from mastering a simple process and executing it consistently over time. Now, I know this is a general overview of what a trading strategy is. If you want to actually learn objective rules of a trading strategy, you can go and check out this video right here. Or if you want to take it one step further, you can check out my 30-day trading challenge, and I look forward to seeing you there.